What if the next move from the Federal Reserve isn't a rate cut, but another rate hike? That possibility is starting to gain attention after a stronger than expected inflation report shook financial markets this week. Investors are now moving further away from expecting interest rate cuts in 2026. In fact, futures markets are beginning to price in a growing chance that the Federal Reserve could raise rates again before the end of the year. So, what changed? Inflation. The latest data showed consumer prices rising faster than expected, with energy costs playing a major role. Oil and fuel prices have surged in recent months as tensions in the Middle East continue creating uncertainty in global energy markets. And when energy prices rise, inflation often follows. Higher transportation and fuel costs can spread throughout the economy, increasing prices for goods and services far beyond the gas pump. That's a problem for the Federal Reserve. Why? Because the Fed's main goal right now is keeping inflation under control. And if inflation stays elevated, policymakers may not have the flexibility to lower interest rates anytime soon. Some analysts now believe the Fed could keep rates steady for much longer than markets previously expected. Others are even warning that another rate hike is no longer off the table. At the center of this debate is inflation expectations. If consumers and businesses start believing inflation will stay high permanently, it becomes much harder for the Fed to bring prices back down. That's why policymakers are watching not just inflation itself, but how people react to it. Interestingly, not all economists agree on where inflation is heading. Some believe much of the recent increase is still concentrated in energy and housing costs rather than spreading broadly across the economy. Core inflation measures have shown more moderate growth in some sectors. So, while the timing may have changed, some analysts still believe the next Fed move will eventually be a rate cut, not a hike, but likely much later than previously expected. For consumers, this matters a lot. Higher interest rate expectations continue affecting mortgage rates, auto loans, credit cards, and business borrowing costs. In housing, elevated mortgage rates are still limiting affordability and slowing buyer demand across many markets. And now, all eyes are turning toward future inflation reports and energy prices. If inflation cools, markets could begin expecting rate cuts again. But if energy costs keep rising and inflation remains stubbornly high, expectations for tighter policy may continue growing. The bottom line? Markets are no longer confident that rate cuts are coming soon. And in today's economy, inflation, not growth, is once again becoming the biggest concern. I am the CEO of Nadlan Capital Group. Our specialty is assisting you in easily obtaining the finest loan available, offering professional advice to help you reach your real estate investing objectives stress-free. Contact today for a tailored consultation where our expert advice turns potential into profitable reality.